This is part two. I'm here with Devin O'Reilly, loan officer with Intercoastal Mortgage. He's licensed in DC, Maryland, and Virginia. So a part of the pre-approval process is the debt to income. So can you just explain that and how that looks if I'm shopping for a mortgage?
Yeah, definitely. So the debt to income ratio is actually the most important part of the pre-approval process. And all that is simply your gross monthly income weighed against what that new monthly housing payment's going to be and any minimum required monthly debts that you have. And so we take that. Normally, you want to make 50% more, at least, than what your new expense is going to be if you include those monthly debts. And so what I've done here is put together a really simple chart that will show you what this means. So for required monthly debts, those are things such as your car payment, minimum credit card payments, and any student loan payments. There can be other uncommon monthly debts that you would have, but these are kind of the basic ones that we look at. And so if you have a $500 monthly car payment, minimum credit card payments of $250, a student loan of $250 per month, your total required monthly debts are $1,000. Now, on the income side, let's say you have $5,000 of gross monthly income. Again, gross is before your taxes are taken out. So it's not going to be your net, it's going to be that gross. If you had $1,000 in monthly debts and $5,000 in monthly income, your debt to income ratio is going to be 25%. Now,
is that good?
That's pretty good. So what we do after that is you're going to have your new mortgage payment, right? So then we add that into that $1,000 and divide it by your gross monthly income. And gross monthly income is something that we take your pay stubs, we take your W-2s, and we do a calculation on our end for what your monthly gross income is. And then when we pull credit, it actually populates your minimum required monthly debts. And so once we're ready to look at a home, we look and see what the new mortgage is going to be. We add it to your minimum required monthly debts. And that's how we get your debt to income ratio, which is the main qualifying factor in whether or not you would be approved for a certain purchase of a home.
Okay. So what if I'm at 40%?
So 40% is actually within the qualifying parameter. Usually we like to see it 45 and below, but certain programs allow up to 50, sometimes even more. In the industry now, what happens is we run an automated underwriting system. So it has all of your personal information, all of your income information, and what the new payment's going to look like. And we run it through this automated underwriting system. It lets us know what that debt to income ratio is, and based on the certain parameters, and that can be things such as, is it a condo? Is this an FHA loan, or are we going conventional? It actually spits out and lets us know if that loan is approved.
Okay. So that's really good to know. So for me, if I'm shopping for a home, I would be able to insert all of that information by going to your application or website and filling out the pre-approval application.
Exactly. So once the application's done, that gives us all the information we need to calculate that debt to income ratio, which is obviously the big piece in qualifying. And so there's what you qualify for in your debt to income ratio. And then on the other side of the coin, there's what you're comfortable paying on a monthly basis. So you may be qualified for way more than you're comfortable paying. And so that's something that we briefly talk about as well, but that can be figured out based on just doing an application and then usually having a 5 or 10 minute phone call to just go over everything. And we can have those numbers worked up for you and ready to go. So you're ready to shop for that home that you're interested in.
Sounds good. So I don't have to obviously go with the price range that I'm pre-approved for. You're going to make sure that I stay within my comfort zone.
Exactly. So that's another thing that we talk about. You'll see that new monthly mortgage payment. And if you're not comfortable paying $4,000 a month for a new home, even though you may qualify for it, you may have other plans on what to do with that monthly income you have coming in. That all plays a part in the pre-approval. We show you what that new monthly payment's going to be.
Sounds good. I think that was very helpful for anyone that is shopping for a home and wants to know more information about the criteria, since debt to income is a big part. So thanks, Devin.
Yeah, thanks, guys.